Hello, guys. Thank you very much for joining in. We're going to be starting out with this chapter, which is Counterparty Risk and Beyond. And this is the start of the series of chapter where they're talking about the basics of counterparty risk. And the idea over here is to, first of all, bifurcate between what is a risk of counterparty when you do an OTC trade and what is the risk that you face in a normal loan lending. Okay, when a bank gives a loan, there is also counterparty risk. But what is the difference between that and how exactly an OTC market trade is? The terminology is different, or how exactly the players are different. Those things are discussed in detail, and then they'll gradually take you move towards the OTC market counterparty risk discussion. They will also be talking about XCVA. Okay, so I'll be running a short PPT along with my presentation wherever I feel that there is some extra information available in a structured way. I'll be running that also. Okay, so first and foremost, they're talking, if you read the paragraph, what is the first part, they're first bifurcating. One second, yeah. So they are bifurcating between what is a counterparty risk and what is a lending risk. Okay, so what exactly is a counterparty risk? Counterparty risk means that suppose if I have entered into a transaction with Barclays and I feel that Barclays is not in a situation to pay me. It can be a variety of ways through which the first would be Barclays has completely declared bankruptcy. Okay. Second thing could be there is a greater probability of default now for my counterparty Barclays. Okay. And all of this situation is concern for me only when I'm expecting something to be fulfilled in the contract. That means I'm expecting some money to come, or I'm expecting some securities to come. That is where I face the counterparty risk. If I have to pay something, then there is no counterparty risk. Okay, so read the first paragraph. Good. Okay, the second paragraph, counterparty risk, when we talk explicitly, okay, they are part of the OTC derivative agreements like interest rate swap, CDS. Okay, a normal transaction also, or a normal OTC transaction, you when you are expected to receive something or get something, you always face a counterparty risk. They've just given you few examples, OTC derivative related examples, and security financial transaction, repo. Why repo? Because in the repo transaction you give a security, okay, and you get money. Okay, so there is obviously a risk that the counterparty not be in a situation might not be in a situation to ask the query. Okay, well, so might not be in a situation to pay back, give my asset back. So that is the repo risk that I face. Okay, and look at this section also. Counterparty risk is complex and systematic trait. Why? Because suppose if one big bank fails, for example Lehman Brothers fails, then in that case it might impact other bigger banks also, and it might become a systematic risk. So even though the counterparty with whom I am dealing, there is no problem with that counterparty, but because the market is going down, there is some systematic risk, he is also facing the impact. Okay, and these counterparty risks can become very big, and it can have an impact on the financial market also, because in the OTC market everybody is connected, everybody is doing trade with each other. Okay, so if one big counterparty defaults, it is going to have an impact with all the other parties with whom he is having the transaction. Okay, they have also used the word not collateralized. What does that mean? Okay, suppose if I am having a trade with somebody in which I don't have any collateral available from the counterparty, and counterparty is supposed to pay me, and in that case of the counterparty default, there is a higher amount of risk because I do not have anything to fall back on. Okay, but if suppose you are in a trade which is collateralized, which is secured, okay, then there is less of a tension for you. Okay, that has been highlighted over here. I'm taking you towards the book now. Kindly read the first paragraph. And they have used the word pre-settlement. I'll be coming to that. Settlement risk and the pre-settlement risk. All good? If there is any query, you can post it on chat. I'll ask, mention the word query, and I'll ask you to unmute, and then you can ask the query also. Okay. The next is lending risk. Okay. The lending risk part, I'll just quickly walk you through the PPT. Now, over here, lending risk means I am giving a loan to somebody. Okay. Or I have purchased a bond. When I'm purchasing a bond, I'm paying certain amount of money. That is where I'm lending to someone. So they're trying to bifurcate between a basic lending risk and a counterparty risk. Okay. The first and the foremost is this degree of certainty for notional principal. What does that mean? Suppose if I have purchased a bond from UBS, okay, and I have purchased a bond of 100 rupees. So I know the maximum loss that I might face if UBS defaults is that 100 rupees. So with very good degree of certainty, I can identify what is my notional principal at impact. Okay, and in the lending risk, it's only I who is taking that risk because I have given money to a UBS. It's only one-sided. Okay, it's only unilateral. So they have used the word unilateral. So two important things to understand with the lending risk. It is very easy to identify the notional principal or the amount that is at risk. The second, it is only from one-sided. The risk is only for one-sided. UBS, who is selling the bond, has no risk because they have already got the money. Simple. So that has been highlighted over here as a lending risk. Simple. What is a counterparty risk? See, when I am into a trade, say for example, interest rate swap. In particular, interest rate swap is a very low amount of risk, but I'm just giving you an example from the perspective that in an OTC agreement, most of the OTC agreement, the risk can be bilateral. That means if in one point in time, I am in positive situation, I am in profit, so I face a credit risk that, okay, the counterparty might not be able to pay me. Okay. After some time, I might be at loss and the counterparty might be in positive. Okay. So now the credit risk is of the counterparty, not mine. So the risk is bilateral. It's not only one party who is facing the risk in the OTC agreement. So when we talk about counterparty risk, it is generally we are referring to OTC market, and we are saying bilateral things. Okay, that has been written over here because at one time the contract might be positive for me, so there is a counterparty risk. But if at one point in time the contract is negative for me, that means I am at loss. Then in that case, there is no counterparty risk for me, right? Counterparty risk will only come into picture when I am expecting something to receive. Fairly simple. Next part. This is the first point that I talked about when we say counterparty risk. The second part of the counterparty risk, okay, when we look at any derivative contract, okay, the amount that you were expected to receive in that derivative contract, that is not very fixed. I'll give you a very basic example. So suppose if there is a swap going on between Ganesh and UBS company, okay, in which I'm supposed to pay 5% and he's supposed to pay actual rate. If suppose in one of the time period the actual interest rate is 10%, then the risk is, say 10%, that Ganesh is expected to receive 10%, UBS is expected to receive 5%. So do you realize in this case the actual interest rate is 10%, so UBS is going to face the risk of difference, gap of 5%. Why? Because UBS is going to receive 5%, pay 10%. So gap of 5% of the notional principal is what UBS is supposed to pay. But suppose in the next time frame, if the actual rate of interest in the market is only 7%, then in that case, UBS is going to receive 5% and pay 7%. Now it's only 2% of notional principal. Do you realize the amount which I am expected to receive will keep on changing? It depends upon what is the value of the contract on that day. Okay, so that is not the case in a lending risk. That is not the case when you give a loan. It is only in the OTC agreement. Okay, so I want you guys to read this entire part. Amisha, answering to your query. Okay, if why is it called bilateral? Because it can be a risk for me, it can be a risk for the counterparty also. Why? I'm answering to the point. So if we look at this, suppose if in the third month the rate of interest goes down to 1%. Now in this case, who is supposed to pay? Amisha, who is going to pay? Ganesh is going to pay, right? Because Ganesh is supposed to pay 5% and receive 1%. On a net basis, Ganesh is expected to pay and UBS is going to pay, receive this. So do you realize now who is going to pay? Ganesh? So who is having the credit risk? UBS is having a credit risk. So it can keep on changing depending upon whether you are in positive or negative of the contract. 1 second. So Amisha, if you want to ask query, you will have to write in the query in the chat query, so that I would know that you want to ask query. Okay. Yes, you can ask the query now.
Sir, understood now.
Acha, clear hai. Okay. Saksham, the settlement risk, kindly wait for a few minutes, because the next slide we're going to be covering the settlement risk also. And if the query is still there, we'll address it again. Don't worry. Kindly read this lending risk and the counterparty risk. All good? If there is the same content is also being explained over here. Okay, so lending risk is generally unilateral, and you know things with certainty in the lending risk. And this part is about the difference between the lending risk and the counterparty risk. Kindly have a read over here also. All good? Any queries till this point? Okay, taking you towards this paragraph. Okay, now over here, they've talked about settlement and the pre-settlement risk. Okay, I'll take you towards that concept also. Now, if you want to understand settlement risk, there is a very popular case of Hertzstadt Bank, okay, which I want you guys to read first. Okay, it is basically where the particular bank, US bank, I think so, was dealing with a German bank, and they were expecting, they were into some currency contract, and the US bank paid the amount. And because of the timing difference, the Hertzstadt Bank was supposed to pay the other day, next day. But before that, there was some regulatory intervention. The regulator of the Deutsche government, they intervened. It's a simple moratorium that has been put on a bank that you cannot deal further. And because of which, what happened? Hertzstadt Bank was unable to transfer the money to US counterparties, and they faced a settlement risk. What is the settlement risk? At the suppose at the end of the contract, I was supposed to pay 100 million USD, and I was supposed to receive 100 million GBP, Great Britain pound. I paid US dollar, but I did not receive GBP. That is a settlement risk. And this settlement risk is at the final day, at the maturity, at the settlement date. Everybody kindly read this case study. It is an actual case. And that is the reason after these kind of incidences, the banking community has come up with IMPS, they have come up with RTGS, real-time gross settlement. The point being, the settlement happens immediately. If you make the payment, it happens immediately. That is RTGS. Okay. Now at a broader level, what exactly is a settlement risk? Okay, it has been highlighted over here. Right, settlement risk happens at the expiration. That is the settlement date. and on that date you basically make payment. Okay, you do your part of the agreement, but you do not receive the other part from the counterparty. So now think about this cross currency swap. From level 1 we have seen cross currency swap. In a cross currency swap, at the start of the agreement you have to pay certain amount, you have to exchange the notional principal, and at the end also you have to exchange the notional principal. Now think about this. If you are in a cross currency swap and at the maturity if you paid but you do not receive, that risk will always be there. That is a settlement risk. Kindly read that first paragraph. Sagar, IMPS, the reference that I did was basically to help you understand that when you make payment, it happens immediately. You don't have to wait. If you do NEFT in a banking transaction, it happens after half an hour as a part of a batch transaction. Counterparty risk, Amisha, counterparty risk is a broader risk. Okay. And the settlement risk is a part of the counterparty risk. That is how you can see it. And you can unmute also and ask your query, but please mention query, QUERI, mention that and I will ask you to unmute. Sagar, I've replied your query. Everybody else kindly read that paragraph which is highlighted on the screen. Yes, Sagar, you can ask your query. Sagar, you can ask your query. There is no problem. Settlement risk is not unilateral. It is basically at the last date, on the last date. Sagar, I cannot hear you. Everybody else? Sagar, we cannot hear you. Kindly check the mic that you're using. Everybody else, kindly go to this paragraph now. What they're trying to understand or trying to make you understand is that this settlement risk is a big problem in an FX market. Okay, and right now what happens is most of the cross currency swaps happens in the market through CLS. I'm now going to explain the concept of continuous linked settlement. Okay, so what happens is in a continuous link, this is not a part of the curriculum. Okay, continuous link settlement is a bank, CLS bank. Okay, suppose Barclays has already done a transaction with UBS. Okay, sorry, UBS. Okay, and they have a cross currency swap. So what they will do is whatever payments that they have to do, okay, they will take that payment through CLS. That means, and this is explicitly for the settlement risk. So at the settlement risk, suppose Barclays was supposed to pay something in $100 million, and UBS was supposed to pay 100 million GBP. Okay, so what is going to happen? Both the counterparties will deposit. They will have an account with the CLS. In that account, they have to make sure that these amounts are available. And when the contract will go for settlement, automatically both the accounts will be debited on the same time. That means Barclays account will be debited $100 million at the same time, and 100 million GBP at the same time. Okay, so what is going to happen is that you will not face the risk that I have paid and the counterparty is not paid. Okay, both the accounts will get debited on the same time. If suppose UBS does not have 100 million GBP in his account, then the transaction will not happen. That means 100 million from Barclays account will not be debited. This is how the CLS actually works, and this is the real example. Okay, and most of the major agreements in the OTC market happens through this. Kindly read this paragraph. Saksham, the reference of CLS that I gave, okay, reference of CLS generally happens for the big payments, the final payment, not the intermediate payment. So suppose if I'm entering into a swap, in between one party will pay, right? That is not taken through CLS. Why? Because there's no situation of both the party paying together. No, that will only happen at the maturity in a cross currency swap. There might be other transactions also where at the settlement both the counterparties are paying. right? Sagar, I'm answering to your query. Whether settlement risk is system related risk during the 30 minutes of NFT? No, settlement risk is not system related risk. It is a risk that I have paid something and the counterparty has not paid me. That is a settlement risk. Parties don't do it voluntarily. There might be some problem. They might have some cash flow issue. That can also be the case. Yes, Ashwita, you can ask your query.
So what is the difference between expiration of a contract and settlement date?
It's generally it is the same date. Maturity date is where you make the payment. Expiration date.
Okay, so basically in the second paragraph, they seem to like differentiate between the two.
Because see, OTC agreement is very specific. Suppose if I and you are entering into an agreement in which suppose we decided that okay, our maturity is on end 31st of March, but we will make payment on 2nd of April. So it can differ also, but in most of the cases, the settlement date is the maturity date itself.
Okay, thank you.
If everybody is okay, pre-settlement risk. Now, what is pre-settlement risk? Any risk that you face before the settlement date of the contract. So if I want to show you the next diagram, this is the maturity and the settlement date. Okay, on this date, whatever they have identified a settlement period of certain days. Okay, so for example, you get time to make payment of 2-3 days, so that becomes my settlement period. Okay, the point or important section that we wanted to highlight is that anything which happens before the settlement date is called as pre-settlement risk. That means if before the maturity I was expected to receive something from the counterparty and the counterparty defaults or the counterparty does not pay, that will be termed at a broader level as a pre-settlement risk. So if I have entered into a swap, in a swap, what happens? Okay, every year or every 6 months, one of the counterparty will pay. Okay, that the net amount that is coming under pre-settlement risk. Okay, and that is explicitly highlighted in the previous paragraph, also this paragraph. हमेशा I'm answering the query in Hindi in a very simple language. हो क्या रहा है कि सेटलमेंट डेट से पहले अगर कोई भी चीज आपको पेमेंट करनी है, आप सपोज आपको कुछ रिसीव होने वाला है काउंटर पार्टी से, अगर वो चीज नहीं आ रही है तो वो आपके लिए प्री सेटलमेंट रिस्क है, पेमेंट डेट से पहले. ओके, Darshan, answering to your query, at a broader level, counterparty risk is a general term. Settlement and pre-settlement are a part of it. In different markets, they might use it in a slightly different way, but that's the broader definition. I'm taking you towards the book now. Okay, I want everybody to read this section, the professor's note. Kindly read that paragraph. Let us look at the transaction with counterparty risk. Okay, transaction with counterparty risk. They have given you different examples. Okay, the first and the foremost is the broader category being security financing transactions in which you can face counterparty risk. Okay, they have highlighted repos and reverse repos. That is the first bifurcation, and securities borrowing and lending. Okay, if I give you a very basic example of a repo, how does it happen? Okay, suppose there is Citibank which has entered into a transaction with UBS Bank. Okay, and this is at time 0. Citibank, suppose, is in need of money. They have an asset, but they don't want to sell that asset because they have some purpose to do from it. So what they will do is they will enter into a repo repurchase agreement in which they will pass on the asset to UBS, and UBS will give dollar amount. Okay, so in this case, what is happening? Citibank is actually selling the asset, okay, to UBS, and UBS is suppose paying $100, and this is happening at time 0. At time 1, what is going to happen? Time 1 means at the maturity. UBS will give back the asset, but now Citibank, when he's repaying or he's buying back the asset, he will pay at a higher amount. This amount is decided at the start itself. So Citibank knows that if he wants to buy back the asset, he will have to pay extra $3. I'm just giving you a very basic example. Okay, so if you look at this entire transaction from the Citibank perspective, this is a repo. Why? Because Citibank is selling an asset to repurchase it later. From a UBS bank perspective, this is a reverse repo. Is there any query on the transaction or the description that I mentioned, repo and reverse repo? There will be some notional principle that is attached to this asset, which can also be covered. Okay, let us go to the book and let us read. They have, if you read this paragraph, they've also talked about haircut, which I have not used. Okay, what is an haircut? So if suppose, I'm just quickly going back to the example. Suppose if asset A was actually worth $110, and UBS is saying that, okay, I cannot give you entire $110 because I feel that this asset has a lot of volatility and that asset might go up and down. My main concern is asset value going down. So I cannot give you entire $110. I will only give you $100. So do you realize I have done a small amount of haircut over here? That means while giving you money, I'm not giving you the entire amount as per the value of the asset. I've given you a reduced value. That is a haircut concept. And that same is also there in your book. So we will be reading that. I want everybody to just have a look at this section. Okay, one more point which I wanted to add. From the UBS bank perspective, in my example, who is under reverse repo, see, he is giving money and he's also having an asset. So he's not worried about, ideally not worried about the counterparty risk much. Why? Because he has the asset, he can sell the asset. The only problem that UBS might face is that when I go to the market to sell the asset might not be sold. There is some liquidity issue in the asset. It is very difficult to sell the asset. That risk the counterparty or UBS might face. Okay, so everybody kindly read this part and mark it a star. Anusha, answering to your query, reverse repo means buying the asset. Yes, it is also termed as buying a repo. Yes. In many books, they use that reference. Yes, Amisha, you can ask your query.
Sir, so in this case, if the Citibank buys the assets, then it is a reverse repo.
No, not like that. See, you have to think it from the perspective that Citibank is selling the asset to repurchase it in the future. So it is a repo, means repurchase agreement for Citibank.
Okay. And if UBS buys that asset, then it is a reverse repo.
No, I didn't get that. UBS what?
If UBS buys the asset rather than selling it, then it is a reverse repo.
No, see, I'll make it very simple. Okay, at the start of the contract, you know who is doing what. Okay, Citibank is selling the asset. Okay, so from his perspective, it is repo. Okay, from UBS perspective, it is reverse repo because he's buying the asset. Now, I'll write it down. Selling and buying. Okay, I hope the query is resolved.
Yes, sir.
I hope everybody else has been reading this part from the book also. I hope everybody's been able to read. Saksham, answering to your query, at time 0, see, I'm explaining this in Hindi. कोई फर्क नहीं पड़ता टाइम 0 हो टाइम 1 हो, आप लोग के दिमाग में ऐसा क्यों आ रहा है कि सिटी बैंक वापस से खरीद रहा है तो रेपो चेंज हो रहा है? ऐसा नहीं है। ओके, एट द स्टार्ट इटसेल्फ हमको ये पता है, इफ मैं सिटी बैंक हूं, मुझे पता है कि मुझे रीपर्चेस करना है, तो मैं एंटर कर रहा हूं, मैं एग्रीमेंट में लिख रहा हूं आई एम गोइंग टू रीपर्चेस, सो एट द स्टार्ट इटसेल्फ इट इज रेपो फॉर मी। क्लियर है सक्षम? सागर, आंसरिंग टू योर क्वेरी, सो कैन एसेट बी ए it what is this asset? Okay, I'm answering to this query. What is this asset? This asset can be treasury bonds, it can be corporate bonds. Okay, it can be any asset which the counterparty is okay to take, because see, counterparty will also think what kind of asset I can agree to take, because if the asset is not sellable in the market, what is the point of taking the asset? So they have a list of agreed assets on which you can give, or asset you can pass it on. Generally it is treasury bonds, generally, because they're very secured. Okay, Sagar, now let us read this section. Okay, this paragraph highlights that if the counterparty, that means if Citibank is unable to repay at maturity, because Citibank has some XYZ problem, then what UBS is going to do, whatever asset they have, okay, they can sell that asset, but again they might face the problem of liquidity risk, that okay, I'm selling this asset in the market, but I'm not getting a good value, or I might not be able to find a buyer. That is a liquidity risk. Nataraj sir, I'm not going very detailed into the reverse repo part, because see, in the repo you also have mark to market. If the value of the collateral goes down, then UBS will say either return some money or give me extra asset. That is how it happens in real life. Okay, there are so many things involved into it. So there is a particular chapter in operation risk which explicitly talks about liquidity risk, which explicitly talks about repo. More detail. What rate of interest you have to pay? Is it general rate? Is it specific rate? Right, sir? Nataraj sir, I've answered your query. So kindly read till this point, and then I'll go toward the security borrowing and lending. What is security borrowing and lending? So in a very basic part, what was happening in repo, Citibank was selling the asset. It was actually a sales transaction. You can think about it that way. Okay, and Citibank is getting an asset. Okay, but think about this in a very different transaction, which is security borrowing and lending. Okay, suppose Citibank in this case and UBS. Now UBS need a particular asset. Okay, because suppose if they realize there is a bond, okay, a treasury bond, for example, which they feel the price of the treasury bond is going to go down, and they want to sell it, but they cannot sell it. UBS cannot sell it because they don't have the asset. So what they can do is they can enter into a security lending and borrowing market. Suppose they meet Citibank, okay, and they say that, okay, I want a particular bond, okay, and I will pay you say 0.0% something percent as a fee. Okay, fee means when you're borrowing from the counterparty, you're actually paying a fees or a rent, and you can think about it that way. So Citibank will give that T bond, specific T bond, okay, because T bonds are also many. For each maturity, you have a different T bond. So when you give that T bond to UBS, UBS can utilize it to short sell in the market. This is one example. Okay, but what is happening? The Citibank is lending the asset, and over here, the UBS borrows the asset. And what is going to happen after some time? What is going to happen? The Citibank will receive the asset back, obviously, because they have just lent it for a certain period of time, and they will also receive some fee related to it. It is like I'm borrowing a security, or I'm borrowing your cycle and I'm paying you a fees for it, right? I'm taking your house on rent. That is also kind of a similar transaction. Okay, I'm just taking you over there in the book. In the book, they have just written 2 lines related to it. So they're kind of similar to repo, but what happens in the repo? Actual sale happens. You give the asset and you get the amount. Okay, but in this case, they only pay a fees to get the asset. Kindly read that 2 lines. All good? Let me take you towards the second part. So we talked about the basic security borrowing lending. There was a repo, and the second part was actual security borrowing and lending in market. Okay. The second major part was OTC derivative, where we can talk about few agreements like interest rate swap, foreign exchange transaction. Foreign exchange transaction means forward transaction. Then you have CDS. CDS means credit default swap. Okay. Now let us go to this paragraph. Now what they're trying to highlight, okay, that in an interest rate swap, when I'm talking about pre-settlement risk, okay, or a plain vanilla interest rate swap. See, previously when we were talking about counterparty risk, I mentioned about cross currency swap. In a cross currency swap, you exchange principal at the start and you exchange principal at the end. But when we talk about plain vanilla swap, in that plain vanilla swap, you basically don't exchange the notional principal. Suppose there is a interest rate swap IRS between Citibank and Barclays, okay, in which Citibank is saying that I will pay you 4% fixed. This is similar to what you have read in your level 1, okay. Libor, the notional principal is $100 million. Very simple and clear. Now what is happening at time 0 when you start the agreement? And this is, suppose this agreement, in this agreement you're making payment every year, and this transaction is for 10 years. Okay, so when you start the agreement, you know what is the Libor rate for 1 year. Suppose that Libor rate is say 7%. Then what is going to happen? Citibank will pay 4% and Barclays will pay 7%. So do you realize on the netting basis, on the net basis, Citibank is going to receive 3% of the notional principal. So from Citibank perspective, they are going to receive $3 million on this date. Fairly simple. The next part, when we reach at time 1, we would know what is the 1 year Libor rate for this time period. Suppose the 1 year Libor rate is say around 5%. Then what is going to happen? And again, going back to the diagram, Citibank will pay 4%. Barclays will pay 5%. So in that case, Citibank will receive positive $1 million. Okay, and this will keep on happening. But the point which I wanted to highlight is this: the exchange that happens is very small in the interest rate swap. The exchange which happens in the between, because the reason it is small, first of all, you're doing netting. So you're saying that, okay, I have to pay 4%, I have to receive 3%. So on a net basis, I'll pay only 1%. So netting is happening, which reduces your payment amount, and it also reduces your risk. In plain vanilla interest rate swap, you don't transfer this notional principal anytime, neither at the start, neither at the end. Okay, so that is the basic idea. If I request you guys to read this part. I hope everybody is good till this part. Okay, let us go to foreign exchange forwards. Okay, now in this case, there is definitely a good amount of risk. Okay, there can be a good amount of risk in this part, because what happens is, in a forward contract, suppose say for example, Reliance is expected to receive some US dollar in the future after say 6 months or 7 months. So it is in the future. Okay, and they're going to receive say $100 million, and they feel that, okay, I want to convert back into INR because I am an Indian company. Okay, and they have entered into an agreement with say Citibank, in which they are entering into agreement that after 6 months, today is the agreement date, agreement signing date, and after 6 months, okay, I will be giving you $100 million, and you have to pay me INR as per the rate that we decide now. Suppose they decided that for $1, okay, it is going to be 70 INR. So on the basis of that, when you multiply, so $100 million is this much INR. So 100 million into 70, that much amount Reliance will receive. And when will they receive the amount? At time 0.5. But the agreement has happened at time 0. Right? Now, what is the risk involved? Okay. Now, think logically. There is the first and foremost risk is at time 0.5 itself. Why? Because at the maturity, if suppose Reliance paid $100 million, they gave, but they did not receive INR. That is a settlement risk that you face. That's a very big risk. Also, during this period, suppose if the INR rate has changed from 70, okay, to say, for example, 55, the actual market rate. Now, do you realize Reliance is in profit? That, okay, I have already done an agreement to convert my $1 for 70 rupees. The market rate is 55. So on paper, Reliance is in profit. And suddenly, if you come to know that, okay, Citibank has defaulted, then you'll be in tension. Whatever profit that I've made, I'm not going to receive now. So this gap was your actual profit. Is everybody okay with this example? Any queries on the example that I've just given? Good. I'm just taking you back to the book. Obviously, in the book, they have not given it in much detail. Okay, so you can read this part. They're talking about increasing the probability that default will occur at least one. Why? Because the maturity is generally bigger. I've given an example of 6 months. It can be for 5 years also, 10 years also, depending upon how much customization I want to do, because it's an OTC agreement, forward agreement. Okay, read that paragraph. Darshan, what profit? Can you please unmute and ask the query? Which part are you referring to? Rest of the people kindly read the same. Acha, okay, I got the query. Sorry, I got the query. You're referring to this profit wala part, right? Why Reliance is in profit? Think about this. Reliance has already done an agreement. Where they're saying after 6 months, I will give you dollar and I should be receiving INR, and I've fixed up that rate at $1 is equal to 70 INR. If suppose the actual rate has gone down between, suppose it has gone to $1.55. So Reliance will be tension free that the actual rate is for $1 you get only 55, but I have done an agreement which is going to be $1 for 70 rupees, because this actual rate, the daily rate will keep on changing, right? You see foreign exchange rates keeps on changing. So if the rate goes down, that means it goes from 70 to 55. So Reliance is actually in book profit, not, it is called unrealized profit. That, okay, you have the right as per the agreement to get 70 rupees, $1, but the current market is very low. It is only 55. So because of the agreement, you're getting some extra money. That is a profit that you have generated. This is unrealized. Okay. Right, Darshan? Okay. Taking you towards the CDS part. Now, CDS is a very basic and simple example of an insurance contract. I'll go into the detail. They have used some important part. Wrong way risk. That is a very basic part. And they've explicitly mentioned the winning party and the losing party. So I'll be addressing that in my example. Okay. Now think about this. Suppose you are Mr. A. Okay. You have entered into a bond agreement with, say, ICICI Bank. So the ICICI Bank has given you a bond of 5 years, suppose, okay, and you have paid around 10 crore rupees to ICICI Bank as a principal amount. Now this contract was a 5 year, and after 1 year or after some time, you realize that ICICI Bank's rating is going down, and you're worried that you might not get your entire principal amount back from ICICI because there is a risk that ICICI Bank might default. So what you can do is you can go to you can enter into an OTC agreement, okay, with some counterparty. Suppose, and I'm taking the name of AIG, American Insurance Group, which was heavily into CDS selling during the 2007-8 crisis. So what you will do is you will enter into an agreement with with AIG that okay, in that is a CDS agreement in which you will mention ICICI Bank. You will mention 10 crore rupees. You will suppose you have taken an agreement for 2 years. Okay, so what is going to happen? The AIG will sign a contract for 2 years. Okay, and Mr. A, who is actually a CDS buyer, and AIG is a CDS seller. Okay, so both of them will have entered into a contract, and what Mr. A is going to do is going to pay the premium, which is the CDS spread to AIG, and it can be quarterly, it can be half yearly, so they can keep on paying. It's a premium that you're paying to protect. If tomorrow, and in the contract, they will have to mention what is a credit event. Credit event can be a single default, it can be bankruptcy, it can be restructuring, it can be downgrade of rating. You have to explicitly mention what is the bad thing that you feel can happen with ICICI. Okay, you'll write it down, and if any of that is happening, then AIG is supposed to pay you the entire 10 crore rupees. That is the CDS agreement. Now, in this case, what is a wrong way risk? Now, wrong way risk happens when suppose you realize that ICICI Bank is going down, there is a big risk increasing, and also you face a problem that AIG is also going down. So now there is no protection for you. This situation is called as a wrong way risk. Okay, where you are relying on AIG to protect you from the loss that you might face from ICICI Bank, but the insurance company itself goes down, okay, or the CDS seller itself goes down because of huge concentration risk or anything, and you face the issue of the value going down, or you face the issue that I am not protected now. So that is a wrong way risk. Okay, so I would request you guys to read this section, the entire part. And they are explicitly highlighting, they have taken an example specific to Greek sovereign debt. Okay, so you have purchased the Greek bond, okay, Greek government bond, and now if you feel that the rating is going down in a very basic part, or the rating is going down of the that Greek country. So kindly read this entire paragraph. Amisha, I'm explaining this in Hindi. So basically, Mr. A जो थे, उन्होंने ICICI बैंक से एक बॉन्ड लिया था. बॉन्ड का अमाउंट था 10 करोड़ रुपीस. खरीदने के बाद उनको टेंशन होने लग गई कि मेरा रिस्क बढ़ रहा है, ICICI पे नहीं कर सकता. तो प्रोटेक्ट करने के लिए आपने इंश्योरेंस ले लिया. इंश्योरेंस मतलब CDS कॉन्ट्रैक्ट ले लिया, क्रेडिट डिफॉल्ट स्वैप. ओके, इसके अंदर आप CDS बायर हो और AIG CDS सेलर है. कॉन्ट्रैक्ट हुआ है जिसमें ICICI का नाम है, which is a single name reference. 10 crore rupees is the principal amount. अगर कल उठ के ICICI के साथ कुछ भी हो जाता है, कोई क्रेडिट इवेंट होता है, so you have to pay back. The AIG will repay the amount. Okay, so basically ICICI बैंक में अगर कुछ गड़बड़ होती है तो AIG will pay you the principal amount, the 10 crore rupees. What is the wrong way risk? क्या होता है कि अगर ICICI बैंक भी डूब जाती है और AIG भी डूब जाती है तो आपको कोई प्रोटेक्शन ही नहीं. That is primarily your wrong way risk. Okay. Ashley, for the CDS, there is no monetary exchange from Mr. A. There is. So Mr. A is going to pay premium. CDS spread is the premium. You'll have to keep on giving that. It's a normal insurance. If I take a health insurance, I have to give premium. Life insurance, I have to give premium. It's the same thing. Prashant, you can ask your query.
Sir, whether the time period the CDS is same as that the time period that buying the bond?
No. Generally, what happens? Suppose if I have taken an example of a 5-year bond. Suppose the bond is for 25 years. Nobody will give you a CDS for 25 years. CDS contract is generally very small, 2 years, 3 years. So what you can do is, once the 2-year period is completed, you can enter into a new agreement with AIG or somebody else.
No, suppose then if ICICI rating is then going down, then how means another party will give the CDS? No,
so the price will increase. No, Prashant, the price might increase. The spread or the premium that you're paying will increase, but you can still enter into a contract, no? Why not? Because see, if
suppose
today also,
suppose that after 2 years,
please go ahead.
suppose after 2 years or 3 years, after the expiring of the first CDS, suppose ICICI Bank means rating is substantially down. If I will not get any CDS, then in that case, I will be at the loss.
Well, that's fine, sir. But you're assuming that AIG is comfortable in entering into 25-year CDS. They generally don't. Why would AIG take a risk of such a big amount of 10 crore rupees for a minimal payment of say 1% or as a premium or 2% as a premium for 25 years on its book? AIG will not do that. So see, you can enter into a contract if the counterparty agrees. No? So CDS contract generally enters for a very short period of time. This is not what I am saying. This is the market practice.
Okay, sir.
Right? If it is better if you're able to match it. But sir, these bonds generally are very long term, 25 years, 20 years. So you can always face the risk of that. So what Mr. A can do is he can enter into a new CDS contract. Obviously, if suppose the ICICI Bank is going down, the premium might be slightly higher, but that's okay. I'm at least getting some protection now. Right? Saksham, what's the query? Can we roll CDS forward after 2 years? You can. So basically, you can go to AIG that please roll it more. Obviously, what AIG will do is they will change the CDS, the premium, na? Depending upon what is the situation. If ICICI is getting better, then the premium will go lower. If the ICICI is going worst, then the premium will increase. Simple. Everybody kindly read till this point and give me a quick confirmation on chat. All good. I'm moving ahead now. Now, institutions that take on counterparty risk. Now, this section is not very important for the exam. What they're highlighting that if you look at the market, entire market, there are large derivative players, there are small derivative players, and they've just bifurcated it. There's no explicitly very differentiation factor that is happening. If you look at JP Morgan, there'll be large derivative players. But if you look at any basic smaller bank from Switzerland or smaller bank from Dubai, they might be a medium derivative player or a small derivative player because their need is very small. Okay, so they've just bifurcated it. So if you read this first paragraph, they are saying that we have bifurcated the institutions who participate into the market depending upon the trading activity, their size, volume, and the coverage of asset. Coverage of asset means they are entering into agreement with on what all different assets. So I can enter into IRS, which is based on interest rate. I can enter into derivative contracts on say forward contracts on temperature. I can enter into say for example option contract on some product. Suppose rainfall also. There are a lot of different exotic contracts you can enter into. So currency, commodity. So depending on what range of product you enter into as a player. The first player, they've highlighted it as a large derivative player. Okay, they have huge number of transactions happening in the OTC market. Okay, they have huge number of transactions. Okay, they cover wide range of asset class, which basically means they are trading into commodities also, FXs also, all of this, right? And in addition, they will post collateral against their position. What does that mean? See, they post collateral just to show confidence in the market that we are such a big company, we have collateral available generally. Okay, so that is the idea. So large derivative players, you can think about it that JP Morgan or Morgan Stanley, Mitsubishi Bank, they enter into these transactions because they have wide variety of requirements. Okay, even Citibank. Now, if you look at medium derivative player, again, certain things will get smaller. Okay, so they also have a large number of clients and they have to use OTC derivative product, but their coverage will not be very big. That means they might not be active into certain asset class. They have a desk for trading derivative in their trading floor. They might have a desk for commodity. They might have a desk for equity, but they are not very actively trading it because they know they do not have the expertise into that particular product or that particular asset. We don't know that asset in detail. Okay, so we don't trade. It is as good as if I tell you, if I open a demat account today, I can enter into equity, I can enter into futures, I can enter into option, but I do not trade. I have all the opportunity, but I do not trade in futures and options because I feel that there is huge risk, or I don't understand the market, so I don't enter into it. I only do equity. It's like that. The smaller banks, now these banks, they generally have very, very basic requirement. They might have a requirement from their clients, or they might have requirement on their own. Okay, so they will enter into trade to protect or hedge, okay, certain specific thing. That is the main purpose. And the clientele who might be trading through them, okay, for example, Ratnakar Bank, they also have a treasury. Their clients want to do some transaction and they're doing it through Ratnakar Bank, and their treasury team will enter into the OTC market and they will do some trade. But they're very specific clients who will have the requirement, and which is creating a need for them to enter into an OTC agreement. So if you read this part, they're explicitly highlighting that reference, and they might not have every time, they might not have collateral available to post, or even if they post the collateral, those collateral might be illiquid. So read this point is important. The last line is important. So as compared to big companies, because big companies, when they trade, they have huge number of transactions going on. They get a lot of asset which you can utilize to give as a collateral. But for smaller banks, they generally post illiquid collateral. Generally, read all these pointers till this section. Amisha, you can ask your query.
Sir, it says that large derivative players have high number of OTC derivatives, and medium derivative players have high volume of OTC derivatives trade. So what is the difference, sir?
See, it's the same thing. It basically means high number of transactions are happening. But for a medium derivative player, they might have a high number of transactions only from, say, equity or FX. But for large player, it might be from across the asset class.
Okay, sir.
Let me complete the last part, last section. Now, if you read this paragraph, what they are trying to highlight is that a lot of these derivative companies, what they do is they face a huge amount of risk, credit risk in the OTC market. Because if you remember from level 1, when you trade on an exchange, there is a central counterparty in between. In OTC market, till the time you bring a CCP in, the risk is yours. You have to face the credit risk, right? So all of this, if you want to manage, you will have to have tools, systems, software, okay, who will basically help you to reduce the risk. Okay, so trade software, trade compression. Compression means if I'm entering into 2-3 trades with a single counterparty. Suppose if I'm Barclays and I've entered into a similar kind of transactions, different transaction with JP Morgan, I can compress that all into one trade. That is trade compression. 2 or 3, 4 exactly similar contracts, but different agreements, I'll merge it into one. That is called as trade compression. Okay, so you do trade compressions also. You have a specific dedicated team for collateral management, right? Because when I'm entering into a transaction, I have to make sure that if I'm in profit, the counterparty should give me a collateral. So there is a collateral team which will call up the counterparty, will ask for the collateral on recorded lines. Okay, when they receive the collateral, they will value the collateral. All of this is going to be there only to reduce the counterparty risk. So read till this point and give me a quick confirmation on chat if you're good to go. Trade compression and netting Saksham is not same. In netting, what happens is that you're netting the amount. Over here, what we are doing is that, suppose, one second, suppose UBS and JP Morgan, they have 5 different transactions, okay, and different transaction with the similar thing. That means the notional principal is same, underlying asset is same, but because transactions are done at different desks. See, I have a London desk, I have a Singapore desk, I have a New York desk. Everybody is trading. Okay, suppose all of these transactions are happening in different locations, but they're booked for UBS and JP Morgan. So what I can take a call is, okay, all of these transactions are similar, no? Why can't we have a single transaction between UPS and JP Morgan, which will combine everything? So it reduces my operational work. That is called trade compression, right? I hope I've answered your query. Ashwita, I've also answered your query. All good. Now, let us keep it. Let us go to the next part, which is counterparty risk terminology. Okay. Now, when we say terminology, what they are saying is this netting, mark to market, all of these terms are explained. Okay. Now, read this first paragraph and mark it as star. What they're saying, see, credit risk. When I face the credit risk, when there is chances or my counterparty has already defaulted. I was supposed to receive money, okay, from the counterparty, but now the counterparty has in a situation of default, okay, and I face the risk that I might not get my money back. Okay, now read this entire paragraph, which gives you a basic bifurcation, basic definition of credit exposure. There is a specific chapter also in credit risk book, which is a future value and exposure, which goes into more detail. Read this paragraph. Is everybody okay with that first paragraph? Yes, Amisha.
Sir, so the credit exposure and the exposure at default are the same?
So credit exposure and exposure at default. No, credit exposure can be any type. That means suppose I've entered into an agreement and I am expecting some money to receive. My exposure is still there. But when we are explicitly using the word exposure at default, that means the default has already happened. Okay, when you are referring to the expected loss formula, no? Exposure at default.
Yes,
this is
sir.
when the default has already happened. What is the exposure at that point in time? So it can be 100 also, it can be 1000 also. So it depends upon what is the risk that you know when the counterparty is already defaulted. Right? Credit exposure is general term. Sagar, answering to your query, it's not like netting. It's basically saying that I face the risk. No, Ashwita, over here, they must have mentioned on defaulting, but that's not the case. If you read the chapter which I was referring to, they have given it in more detail. It is not only about at the default time. Okay, they refer to it as when you start the agreement. Also, they do a lot of calculations, potential future value, potential future exposure, all of that. So that is not true. It's not only at default. It starts from the day one. If you're in profit, you face the credit exposure. Okay, read this section. Okay, now they've used the word replacement cost, okay, and zero recovery value. What is zero recovery value? Now think logically. Now, if I have entered into a transaction, okay, if I have entered into a transaction with a counterparty C, in which I've said that I will buy something at, say, for example, whatever that asset is. Suppose I've decided to buy something at 100 and I will get an asset. And this is going to happen after some time in the future. I'm just taking a very basic, simple example. And suppose during that period of time, okay, the value of that asset has gone to 200. in the market, the value has gone up to 200. Okay. And suppose, and I already have a contract with C, Mr. C or the company C. And suddenly we come to know that, okay, there is a chance, or suppose the counterparty C has defaulted. Now, do you realize if I want to see, I'm facing a very big risk, the issue that I was already entered into, I was already in a contract. Now, counterparty C might not be able to fulfill the agreement. Now, if I enter into a new agreement, suppose now if I go to Mr. D today, okay, so Mr. D will say, okay, now I'm going to enter in the contract at $200, right now. So do you realize because of this credit risk, you have to replace the contract. And when you're replacing, it is costing you $100 more. Is everybody clear on the replacement cost? Is everybody clear? Kindly confirm. This is important. And I've tried to give you simple reference. I'm going to explain again. I'm explaining in Hindi, Amisha, for you. See, एकदम simple है. मैंने किसी के साथ agreement किया. इसमें agreement में मैंने ये लिखा था primarily कि $100 मैं आपसे कोई चीज खरीदूंगा. मार्केट में उसकी वैल्यू 200 हो गई है, काउंटरपार्टी डिफॉल्ट हो गया. अब मैं किसी और के साथ अगर अग्रीमेंट करने वाला हूं, बीच में ही डिफॉल्ट हो गया, अग्रीमेंट करने वाला हूं, जो मिस्टर डी है वो थोड़ी 100 रुपए पे अग्रीमेंट करेगा, वो तो आज के वैल्यू के हिसाब से करेगा ना, 200 के हिसाब से. तो मेरे लिए तो वो चीज अब 100 रुपया महंगा हो गई ना. सिंपल. That is a replacement cost. So kindly read this section, read this paragraph. I've explained the content. Kindly confirm. I want everybody to read this part. I just explained the replacement part. See, exposure, I'm answering to your query, Saksham. Exposure, when the moment I realize that the counterparty has defaulted, my exposure has stopped because I know for sure now there is a default. The contract has come to an end. Why would you keep the contract running? You will stop the contract, right? Your exposure will stop. You'll calculate what is the amount that you are expected to receive. The company C will go into liquidation. You'll wait for 1 or 2 years to receive that amount. That is a real way to deal with it. It is the exposure. See, Saksham, you did not understand the logic of exposure. Exposure means I was supposed to receive some benefit, okay, something which I did not receive because the counterparty default, right? So now the exposure, whatever that time frame is with counterparty C, that has stopped because the counterparty C has defaulted. Khatam ho gaya, counterparty C default ho chuka hai. So now when I'm dealing with that transaction, there's no further increase in exposure. Suppose I was supposed to receive the asset at $100. So I will wait for the liquidation to complete. Liquidation means the company will go into liquidation process, chapter 11 file hoga, pura jo process hai wo hoga, and then they will give me the asset at $100 or whatever that is. Or I might not be able to get the asset, I might get some compensation for it. But the impact is that I will face a replacement cost also because I have to enter into a new transaction at the same time. Right? Kindly read that paragraph. When we use the word current exposure, now these all terms will come in your future value and exposure chapter in detail. So I'll be covering there. Okay. So what is this potential future claims? I'll just give you an idea. So the way you calculate VAR is on the negative side. Okay. You calculate VAR. Similarly, you will also calculate for the positive side, what is potential future exposure. Okay. So it's a VAR for the positive side because positive side only comes into picture when there is a credit exposure. Right, Amisha, you can ask your query.
Sir, so if sir, so in this we have the collateral as the asset. So we can simply sell it in the market. Why are we?
No. In my example, if I go to my example, there is no collateral. I was expected to receive asset. जब मैं asset खरीदूंगा 100 रुपए में तभी तो मुझे asset मिलेगा ना. Collateral कहाँ है?
So basically, we are paying $100 and then we are getting the asset, and default is He does not.
Simply, suppose it's a forward contract. Today at time zero, you have entered into a contract to buy the asset after 1 year. In between, counterparty C defaults. Nothing has happened, nothing has exchanged. But for you, there's a paper loss, no? Because you were supposed to get something at $100. The real market price is 200. Now you're not going to get the asset from the counterparty C. You have to enter into a new contract. The new contract will also enter at the $200 part. So do you realize there's a loss involved into it for this counterparty, Ganesh?
Yes, sir.
I am moving towards the next part, credit migration and probability of default. Now, what is credit migration? Suppose if I have entered into a counterpart agreement with, say, for example, UBS, and over a period of time, if there's a credit migration of UBS, my counterparty, that means the rating goes down. See, if the rating goes up, there is no problem. I am only concerned about risk. So if the rating goes down of my counterparty, there is good chance that he might default. So whenever we enter into a long-term contract or long horizon contract, you always face that impact that, okay, over a period of time, my counterparty's rating might get deteriorated. Okay, when that rating goes down, the probability of default is also going up. Why? Because see, if somebody is having a rating of AAA, the probability of default of that company is going to be very, very low. But if somebody is having a rating of BBB, the probability of default will also be big. So read this section, the last paragraph. Let us move towards the next section. Now over here, they are talking about that future default probability will decrease over time, especially for far into the thing. Now they're trying to connect back to the situation. Suppose if the company is a BBB rated company, I'm just taking a very specific example. Suppose the company is BBB company, and there is a good chance that they might default in the near term. But if they're able to survive, this near term, this is maturity, okay, then in that case, primarily, if you're able to survive, then your probability of default should be able to come down. The reason being, because in the near term there was a risk involved, and now since you're able to sustain that near term period, then your probability of default would ideally go lower, because now you've understood the business, you've got support from other people, and you've started making profitability. So that way, okay. So what they're trying to highlight over here is that if you are a smaller company, or if you are suppose a startup, okay, a startup is facing a risk in the initial few years for survival, but if they're able to sustain that period, then generally they go up, their probability of default goes up, okay. So they are trying to connect back this section. If you look at bigger companies, for example, Reliance, and if you say that what is going to be the probability of default for Reliance over a period of time, okay, and over a period of time in the sense, say 60 years, 70 years, the probability of default will be high, because you don't know what is going to happen with them after 50, 60 years. So uncertainty, okay, is different for different set of companies. I'm taking you toward the second point, okay. Expected deterioration of credit quality suggests increasing probability of default. This is what I said. If you move from AAA to BBB, the probability of default will increase. And expected improvement in credit quality suggests that decreasing probability of default. So kindly read all the 3 pointers. Yes, Ashwita, you can ask your query, please.
So the first point looks counterintuitive, or we can imagine it as the default probability increasing over time, and after a point it starts decreasing, right?
Okay, I'll explain this in a different way. See, if you look at normal scenario, okay, if I don't talk about Reliance, a very big company or a very small company, generally what happens, if you're giving a loan to your friend, okay, for one day, the risk is very low. But if you're giving a loan to somebody for a longer period of time, the risk is very high, right? So when the maturity is very big, the probability of default will ideally be very big. Right, Ashwita?
Yeah.
So you can connect to that point. I was going one step ahead. If you look at other chapters also in credit risk, they explicitly highlight that probability of default, okay, for a very good company, there is some positive probability. So if you look at a very big company, the probability of default will slowly increase over a period of time, over a period of maturity. That means 30 years, 40 years. But smaller companies or companies which do not have good financial power, okay, so that probability of default might be very high initially, and it will go down over a period of time, because the only risk that they face is the initial risk. They might not be able to sustain. So I just went one step ahead in explaining that, which is not directly written in the book.
Okay, thank you.
I hope everybody is good. So I'm moving towards the next part. Now they have used a word of mean reversion. Okay, now mean reversion is a very, very basic part which focuses on the average. Okay, suppose if you're at a top of the average, or it can be anything. Okay, it can be volatility, it can be interest rate. So you will come down and you'll touch the average. It can be if you're down, then you will come and touch the section over above. So this also happens with respect to the credit quality. They're trying to highlight that part also. Companies who are strong in credit quality, over a period of time, their credit quality might deteriorate. And this has happened for most of the big companies. Okay, and for companies with a weak credit rating, they're trying to improve over a period of time. So this was the point which I was trying to make, Ashwita, that the credit quality might change for two different companies over a period of time because of the mean reversion logic. All good. Let us go to this section. What is the recovery part? Now over here, the recovery section explicitly highlights that this is similar to your expected loss formula. When we talk about expected loss, it is exposure at default into PD into loss given default. What is this loss given default? 1 minus recovery rate, right? So this is something which is again repeated from level 1. Recovery rate primarily tells you how much amount I will get if I basically if the default happens and if I try to sell the collateral or anything that I have available for the transaction. So I might get some recovery out of it. What is mark to market? Mark to market is, and again, there is a replacement cost. Okay, so I'll connect back to the logic. So mark to market is if I look at a contract, suppose on a daily basis throughout the transaction period, from start till a particular time t, not necessarily maturity. Okay, so during the entire period, okay, sometime I might be in profit because I have a positive MTM. Sometime I might be a lot, which is a negative MTM, and that might keep on happening. Okay, so in some days you're in profit, some days you're in loss. Simple. So that is going to continue. That mark to market represents at the end of the time period, at the end of the time period, at the end of the day in exchanges. And OTC market, it can be end of the week also. You basically try to identify, okay, what is the who is the winning party, who is the losing party. The losing party accounts will get debited, okay, and the winning party account will get credited. Okay, if you look at examples from FRM level 1, you had the reference with respect to initial margin, variation margin. So your margin account will get debited and will be passed on to the winning party. That is mark to market. Okay, so ideally, mark to market is a measurement of the replacement cost. It simply means, see, when I enter into, I'm going back to the example which I mentioned about going into a transaction with, say, UBS, and I was supposed to get an asset at $100. Okay, and suppose UBS has defaulted, and the day the UBS defaulted, the actual cost of the asset is 200. Simple. Now, what happens is when I enter into a new contract, okay, so the new contract will obviously be as per today's price, right? So do you realize the difference between today's price and this old price is actually the gain that I had from the contract? Because do you realize I was supposed to get an asset at $100? I was supposed to get an asset at $100. The actual price is 200. So you were in profit, right? Simple है ना, क्योंकि कोई चीज 200 की है मुझे 100 में मिल रही है, तो I'm in profit of $100, right? Now, when I enter into a new transaction, I might have to enter at 200. So because of which I'm actually losing that $100. So when I enter into a new contract, the replacement cost, the extra that I have to pay, is that mark to market loss that I'm facing because the counterparty has defaulted. Is everybody clear on the example? Right?
Sir, so basically,
one second. I want everybody to read this. Yes.
Sir, so basically 200 is the replacement cost and the 100 rupees is the MTM. That difference.
No. I'll explain it in Hindi. 100 रुपए तो तुम वैसे भी पे कर रहे थे ना, वो तो तुम्हारा ओरिजिनल ट्रांजैक्शन था, मतलब तुम तो रेडी थे 100 रुपए देने के लिए, अब तुमको ज्यादा कितना पे करना पड़ रहा है? 100 रुपया ना?
Yes, sir, 100.
वो रिस्क है तुम्हारा कि वो कॉस्ट हो गया ना, अरे तो बेनिफिट मिल रहा था, अब मुझे एक्स्ट्रा पे करना पड़ा, तो मेरे लिए वो रिप्लेसमेंट कॉस्ट जैसा बन गया अभी, ऐसा।
सर तो ये MTM और रिप्लेसमेंट में थोड़ा डिफरेंस
नहीं, वो ये बता, they are trying to tell this concept that you can, MTM is nothing but if you look at the default date, it is similar to a replacement cost, because when you enter into the new contract, it is going to enter as of current section or current price, right? So current replacement cost क्या हो जाएगी आपके लिए, कह रहे 200 रुपए में लेना पड़ रहा है चीजों को, बट जबकि आप तो 100 रुपए में एंटर कर चुके थे, तो वो जो एक्स्ट्रा आपको जा रहा है, that is the loss that you are facing, right? Plus you will also have to enter into, I did not see this point, transaction cost and bid ask spread, because जब आप नए कॉन्ट्रैक्ट में एंटर करोगे तो there is going to be some transaction cost that you might have to pay, right? कोई broker होगा, कुछ होगा, so you might have to pay that also. That is an extra cost, right? I'm moving towards the queries. I hope everybody has been able to go through the content. Which part, Amisha? MTM measurement part.
MTM is a measure of replacement cost.
वही मैंने आपको बताया ना. What was the MTM? In this case, मेरे लिए MTM profit था ना 100. ये clear है?
Yes, sir.
Right? तो आज के दिन में जब मैं enter करूंगा, okay, तो I have to enter at 200 rupees, right? So ये 200 का reference आप समझिए कि there I have to replace the agreement. I have to enter into a new agreement, तो मुझे एक extra cost लग रहा है. That is similar to my MTM that I have lost. मुझे पैसा मिला भी नहीं और मुझे actually में extra पैसा भरना पड़ रहा है because I am entering into a new cost. So that extra $100 is a replacement for me. I'm paying that extra part because I have to enter into a new contract because my old contract has failed. और 100 कहाँ से आ रहा है? Because of the MTM profit, which I was expected to receive. If there is still a query, we'll take it at the end. Don't worry. If there is still a query, okay? We'll go towards this example. First question, when considering counter, you guys can start solving the first question, please. Can anybody start the 25.1 section? Okay, when considering the counterparty risk, which of the following financial product has the largest outstanding notional principal in the market? What do you think? Is it repo? See, please understand, in the marketplace, they're not talking about individual transaction. Okay, they are saying which product is heavily traded. Okay, so if you look at OTC market, the most traded product is interest rate swap. This was also there in your level 1 in your exchange and OTC derivative market. They have highlighted which product is heavily traded. So it was interest rate swap, then FX, then I think so commodity was at the last. So all of these, equity was also at the last or second last. So interest rate swap is a heavily traded product. So they are not asking for a per transaction, they are asking for the marketplace part. Okay, let us go to the second quiz. Liz Parker, can you guys start reading the content and start solving? Let me start solving the question. So Liz Parker is basically an agent, credit migration. An excerpt of our report states the following part. Future default probability will likely increase over time, okay, especially for period far into the future. Read the question properly. I think so a lot of people have still not answered. Future default probability will likely increase over time, especially for period far into the future. Okay. Now, when also look at the second point. When computing a probability, default probability of a counterparty under a risk neutral measure, we need to first determine the actual probability of default. Is this true? See, actual probability of default, ideally you cannot find in a proper way. Actual probability of default. Right, I will go to this question. I think so a lot of people have confusion with respect to C and D. Okay, because both I feel this is incorrect. Why? Because most of the risk neutral concepts, it might not be possible first to determine the actual PD. Okay, so that can be the case. I will go to the solution also to address and connect back to the content. 1 second. Read this solution. They're highlighting D and they've got into 2 parts. This is the first part and this is the second part. Now I want you guys to read the second part first. What they're saying, theoretical market implied probability. What does that mean? It basically means whatever information that I have, yes, whatever information that I have, when we talk about risk neutral, it is derived from the market prices. It is not the actual probability of default, because you don't know what is the actual probability of default in real life. आपको थोड़ी पता है कि कौन सी कंपनी कब डिफॉल्ट होने वाली. So actual probability of default, you don't know. You only take from the current market price or something based on historical understanding. So this is straight away wrong. Everybody's okay with that part? I'm going towards this part. Now read this section. This line is important. Now what they're trying to tell you over here, now obviously the statement is not very clear in the book also. They're trying to highlight a point that generally what happens is, it is a concept related to mean reversion. Okay. So if the probability of default is very low, okay, then it will increase over a period of time. Okay, the credit quality will change and you will actually go towards mean reversion, and higher likelihood that the default will have already occurred in some earlier point. What does that mean? If the company is very bad, okay, the company is at BBB rating or say CCC rating, if they're able to sustain, okay, the short period of time where there is a good chance that they might default, if you're able to sustain, then ideally their probability of default should go down for a period of time. This was the point which I was referring to when I was talking to Ashwita. Is everybody okay on the answer D? Give me a quick confirmation on chat. Right? I know the first point is not explicitly written in detail as an option. That can lead to a confusion. Which of the following statement regarding the counterparty credit risk is most accurate? Most accurate. Kindly read that. I'm answering to the query which is being raised. Okay. Why the first point is incorrect? Because it says it will increase. And if you read the option solution also, it is decreasing. Right. I'm moving towards the third question. Which of the following statement regarding the counterparty credit risk is most accurate? Counterparty credit risk is unilateral? No. OTC derivative contain less counterparty risk than exchange? No. Precise future value of the contract is uncertain, but the counterparties are aware of whether the future value will be positive or negative, which this line says that you will know at what particular date you'll be in profit or what particular date you'll be in loss. Right? So this is not true. How would I know after 10 days whether I'll be in positive or negative? That's not true, right? Okay. Counterparty risk now is associated with counterparty defaulting to prior settlement and defaulting during the settlement period. Now this section was also there in the PPT, where I said that generally when we say counterparty risk, it is more about pre-settlement risk. That's the nomenclature used in the market. Hence the answer is D. Hence the answer is D. All good? Now, we are moving towards the next part, managing counterparty risk. Okay. Now over here, how do we make sure that when we are dealing in the OTC market, it is not actually the whatever counterparty risk that we might face, it is actually reduced to a certain extent. So how do we deal with that? So first and the foremost that you can do is, it is also written that whenever you enter into any agreement, you should make sure that you enter with a counterparty which is highly rated. Highly rated. So in investment banks, what happened is, whenever a counterparty you want to enter into an agreement with a counterparty, you have to onboard that counterparty. Okay, when you onboard, you will take all the documentation of the counterparty, you will do your own legal check, who is this counterparty, because you don't want to end up dealing with a terrorist organization, right? Or any incorrect company, illegal company. So you will do your own analysis. You will also do your credit assessment, that what is the credit risk when we enter into a transaction with him. Once you do all of this, you will onboard that company, and then only you'll be able to enter into a transaction. So when you enter, you know what is the credit risk of these companies. So you would, if you want to reduce the counterparty risk, you should always and always trade with high rated counterparties. Right? So that is the first point. Kindly read the same. That is the first point. All good? Cross product netting. Now they have given you an example also. Mark this as star. okay, cross product netting, this might come as a reference, okay, in your exam in terms of theory. Okay, so counterparty A and counterparty B, okay, so they are now this entire table is from the counterparty A's perspective. Okay, so there is a trade with positive MTM. For counterparty A, it is positive MTM, obviously zero sum game. So counterparty B will have a negative MTM. Similarly, there is one more contract, the first contract and second contract. Now, if we are not doing any netting, then what is going to happen? Counterparty B will pay $20 million as per the first contract and will receive 17 million as per second contract. So two different things are going to happen. The payment of amount. Okay. And what is going to happen with respect to this section? If there is exposure with netting, do you realize the exposure is now only 3 million? Because what we are doing at the end of the day, we are saying, okay, if I'm counterparty A, okay, as per the first contract, I'm supposed to receive $20 million. And as per the second contract, I'm supposed to pay 17 million. So we'll net it and I will only receive $3 million. Right? So the exposure, okay, is only 3. Now, why are we talking about exposure? See, the risk for me, if I am counterparty A, okay, if we do netting, the risk for me is basically $3 million, because if today counterparty B defaults, I'm only going to lose $3 million. But if we go to this without netting situation, what is actually happening? I am paying $20 million. Sorry, company A is going to receive $20 million. I'm going to pay $17 million. So there is a huge risk because you're not netting and you're making the payment. So suppose if this situation happens, if you are counterparty A and you paid $17 million and counterparty B defaults, so you lost that $17 million also, and you're not getting that $20 million. So it's a double impact for you. Is everybody clear on this table? Because if you're able to understand table, then the paragraph will be easy. All good? Now read this part, this entire thing. Now, whenever you want to do this netting, it cannot happen overnight. You will have to add that as a part of the agreement. Okay, all the legal and operational risk has to be accompanied with the agreement part. I hope everybody has read this section. Netting will always reduce your risk. It will never increase your risk. You can think it from that perspective also. Okay. Let us go to closeout. Let us go to closeout. Okay. Now, what is a closeout? Suppose if you have entered into a particular transaction. Okay, Lakshya, I'm answering to your query. How the exposure is 0. See, it is not. You did not understand the line. Exposure का मतलब क्या है? अरे नेट करने के बाद काउंटरपार्टी ए और बी के बीच में अगर नेटिंग होती है तो काउंटरपार्टी ए को अभी $3 million मिलने वाला है. तो क्रेडिट रिस्क किसका है? लक्ष्य, आई एम आस्किंग टू यू, क्रेडिट रिस्क किसका है? ए का ना, क्योंकि उसको कुछ पैसे मिलने वाले. बी तो पे करने वाला है भाई, तो बी का क्या रिस्क है? बी के लिए कोई क्रेडिट रिस्क नहीं है. इज एवरीबॉडी ओके? लक्ष्य ओके? Now let us come to closeout netting. Okay, immediate closing of all the contracts of the default party. So what basically you do is you add a section in your contract which basically says that if there is a default, then primarily, okay, you will actually stop all the contracts with that counterparty. You will do the valuation of all the transactions, and you will net and you will see how much is the final amount either you have to receive from the counterparty who has defaulted, or how much of the amount you have to pay to the counterparty. That can also be the case. Now think about this. If suppose there was an agreement between A and B, and B has defaulted. If suppose A had to pay as per the contracts, we did the valuation of the contract on the day of the default, and we did the netting and all, and final amount is that A has to pay $10 million, then definitely A will have to make that payment and close the contract. Okay, B has defaulted, huh? B has defaulted. Okay, if suppose you are going to receive the money, you were supposed to receive money from B, suppose $7 million, suppose a different scenario, then you know this amount of $7 million. Okay, you can go into a market and do other transactions as a replacement of the original transaction that you had. But you know this amount of $7 million, what is going to happen when this company B will go into liquidation? You know the exact amount I am supposed to receive. Okay, and they will follow the legal proceedings, they will follow what is the rule of the court, and then after that they will have to pay whatever amount. So in most of the cases, since the company is defaulted, you don't get entire $7 million, you get lower amount, say 50% or 40% of the amount. Okay, read this section. So the point which I was referring to is highlighted over here. If there is a default of the counterparty and you are into loss, you are into negative part, you'll make the payment. But if you're into positive, you are expected to receive, you'll make a claim and you will wait for the money to come, because legal things will take time. Kindly read the paragraph and confirm back to me. All good? Moving towards the next part, which is collateralization. Now, this collateralization was also there in your securitization chapter. What is collateralization? Whatever agreement that you're having some form of collateral available. So if suppose you are in profit, you're asking a collateral from the counterparty and you receive the collateral, you do the valuation of the collateral and keep it. If counterparty defaults, you can sell the collateral, right? Again, ideally we assume that if you have a collateral in place, okay, the collateral reduces your risk. That is true in most of the cases. But suppose if the value of the collateral goes down, then the collateral is not available to protect you to the exposure amount. Suppose the exposure or the profit amount that you were supposed to receive from the counterparty was 100, but because of some volatility in the market, the value of the collateral has gone to 70. So when you sell the asset in the market, you will only get 70. You will still face a risk of 30. So there are other issues related to collateral. The volatility of your pricing, okay, market risk. Volatility pricing means market risk, that the price of the collateral might move up and down. There might be operational risk involved into it. Suppose while getting the collateral, the valuation did not happen properly because the team members did some mistake and the valuation was only 30, but you calculated and you got 70. So there can be some operation related issues also. Legal risk, suppose you have the collateral in hand, but you cannot sell it because the legal right is with somebody else. So all of this can create a problem for you when you are selling the collateral. So the gist of the point is, when we say collateralization, we generally assume that there is a collateral to cover you, okay, but in reality you face other risk also when you're getting the collateral. That is the point. So kindly read it and mark it as star. See, margining, Saksham, answering to your point, how does margining comes into picture? If the value of the collateral goes down, the counterparty might have to post more collateral, because collateral ideally should be able to cover your exposure. Huh? So the margining keeps on happening. You'll keep on asking for more collateral if the value of the collateral goes down. But the problem is, if you're asking for a collateral, it may take some time to get the collateral. And if the counterparty is in default, you'll definitely not get the collateral, right? I've explained to the point how it is related to margining. I am moving towards the walkaway feature. A walkaway feature is very simple and clear. Okay. Now, this has to be added in your contract. It basically says that if suppose Citibank is having a transaction with, say, Barclays, and they already have a contract, and in that contract, they have a walkaway feature added. Suppose counterparty B has Barclays has defaulted, and Citibank was supposed to pay something. Now, walkaway feature is very harsh. What does that mean? It basically says that if there is going to be a default of the counterparty and I'm supposed to pay some dollar, I will not pay that dollar amount. So if I'm in negative MTM, I will not pay the amount. I will just walk away from the contract. Okay. If I'm into positive, then I will definitely receive the amount. Now this depends upon the contract which is there between the two parties. We call it as one-way CSA, terms and agreement, or two-way CSA. Now you will say, aise kaise? Why would such a thing might happen? Okay. So in that case, suppose, think about this. If you're dealing with Tata, which is a very big company, big brand, and you are a startup. Okay. Now, why would Tata deal with you? Okay. If they're dealing, they might put terms and conditions. This is an OTC agreement. So terms and condition might be as per their requirement. So they might add a walkaway feature and say that since you're a very small company, we might face an impact when you're dealing with you. So we will have a walkaway feature that if you default and I'm supposed to pay, I will not pay. But if you default and you're supposed to pay, you will have to pay. That is how it works. I know it is not fair, but this is very harsh terms of the agreement, which generally counterparties agree to, because if they want to do a transaction with a particular counterparty also. All good. Diversification. What is diversification? It simply means when you're dealing in the OTC market, don't just deal with one counterparty. Deal with majority of the counterparty. Why? Because if one counterparty also defaults, you will still not face that risk, because if there is concentration, if suppose 70 or 80% of your transaction is happening with one counterparty, and if that counterparty defaults, you will face the impact, right? That is this diversification point. Okay. Also, what you can do, you can get CCP in between the transaction to reduce your risk, right? Because if this CCP is in between, if you do novation and bring CCP in between, then you will face that impact, right? Your risk will get reduced, no? Because there is somebody else sitting and managing the risk of the contract. So kindly read till this point and give me a quick confirmation on chat. Let us move towards the next section, mitigating counterparty risk. Now, some of the content is going to get repeated. Okay. What is netting? This is payment netting, basically. So you have, I suppose if I have to pay you $100 and you have to pay me $60, we'll net and I will only make payment of $40. Right? So if there is an offsetting amount that has to be paid, because $100 has to be paid and $60 has to be received, these are offsetting, ulta amount, then only the netting can happen. So read this first paragraph. Netting, it will always reduce your risk. Some of the part is repeat, like I said. Moving towards the collateralization. Okay, what is collateralization? You ask for collateral from the counterparty. You have to manage the collateral. Okay, whatever is the legal documentation, you have to check. You need to do the valuation of collateral, and everything has to be done. Okay, and that collateral actually reduces your risk. But there might be some legal related issues, some operation related issues, liquidity risk. I've explained all of this, right? Legal risk, liquidity risk, because when you want to sell the asset, the market is not available. Or when you want to sell the asset, there is some legal issues related to it, some court case going on, something like that. I'm just giving you an example. So read this collateralization also. All good. Next is hedging. Third way to reduce your risk. You guys must have seen in level 1 when we're doing futures chapter, you can hedge the original risk that you're facing. So I'll just quickly just give you a brief. So you have an original transaction, okay, where you face a risk of $100. So what you will do is you will enter into some hedging instrument, which is going to be, say, some instrument like futures, or could be a forward contract, anything, okay, which will help you to cover that $100. Right? There was a concept of basis risk in level 1. You had a hedge ratio. Okay, all of this was primarily done, or the concept was that if you hedge your risk, you will not face the counterparty risk, ideally. Okay, so you enter into some offsetting transaction to mitigate your risk, to mitigate your counterparty risk, to reduce counterparty risk. Read that paragraph also. Let us go to the next paragraph. This entire section, central counterparty. Now, central counterparty is CCP. Okay, when you bring in CCP through novation, suppose there is a transaction going on with respect to A and B. They were doing the bilateral clearing, but now they decided, no, we don't want to manage this. Let us get a CCP in between. So they will enter into a process of novation. Okay. And this situation will happen. Now, every risk is managed by CCP. Obviously, CCP will charge a fees for it, but risk is reduced for you. Okay. Now the collateral part is managed by them. The valuation of collateral is managed by them. And if A defaults, B is not worried, because for me, the counterparty is CCP. The same thing repeated from level 1, right? So all of this is generally done to reduce the risk. And when you bring in CCP, you improve operational capabilities, because previously A and B both had a team who was calculating doing the valuation of the trade, asking for collateral, doing the valuation of collateral, okay, managing the risk of the collateral. Now everything is gone. It has to be done by CCP itself. So operational efficiency is coming, liquidity risk is coming, liquidity risk is reduced, sorry, and the systematic risk is also reduced. So read this entire part and give me a quick confirmation till this point. I will take the address. Bhavya, answering to your point, client or counterparty. See, in a lot of the cases, these big banks, when you go to the trading floor, they take positions on the basis of client. So client tell them that I have a risk, I have X specific risk, and I'm going to, I want to do a certain transaction and also hedge it. So they will agree for a certain amount of hedging. Okay, so your trader would ideally do the transaction, okay, with respect to the client's exposure also. Right, Bhavya, I've answered your query. Kindly read till this point. Moshmi, answering to your point, central counterparty will reduce the risk. It reduces your credit risk and also kind of, yes, operational efficiency is also improved. Systemic risk is also reduced. I've answered your query. Kindly give me a quick confirmation till this point. Okay. What about others? People are not responding. So before we go to the next part, now over here they've got into quantifying counterparty risk part. Now before we enter into this, I will take you towards CVA. Okay, there is a specific chapter which talks about CVA. Okay, what is the CVA basically? And I'll give a reference in both English and Hindi for the audience. Okay, so what is happening? Okay, suppose you have CVA is basically a risk that you face because you enter into the transaction. Okay, and you adjust the pricing because you are facing the risk. Now think about this, right? That if there is A wants to enter into a transaction with B, okay, and let us take an example of bond, okay, selling of bond. Ideally, the bond price is $100, and this B is a bond issuer, okay, and wants to sell bond to A. Now, if A feels that there is a risk involved in dealing with B, okay, so what he will do is he will not buy the bond at $100. He will reduce the price and he will say, no, I will not buy at $100. I will buy it at 75, sorry, 95, 96, 97, or 93, depending upon what all risk you face. So what bank also do is they will include that risk in your pricing, in the sense that they will, when they're dealing, they will reduce the price when they are entering into a transaction. So instead of buying a thing at 100, they will say, no, I will buy it 97 because I face a risk when I enter into a transaction with you. So that reduction, so from 100, you are saying I will only pay 97. That difference of $3, is basically your CVA. So what you are doing, you face a risk. Instead of entering into a transaction of 100, you reduce the price and you entered at 97 because you face that risk. Now CVA is a general term. Okay. Now you can bifurcate that $3. Okay, that $3 is a risk that you're facing because of XYZ reason. So you can bifurcate that also. I will now explain it in Hindi also. It is not an haircut. Okay. I will explain this in Hindi. Suppose आप किसी के साथ transaction करने वाले हो, okay, और आपको ये realize हो रहा है कि सामने वाला counterparty में कोई risk है, तो obvious सी बात है कि आप एक particular pricing जो उसने quote किया उस पे तो enter करोगे नहीं ना, because आपको भी तो factor करना है, because आप जब उसके साथ trade कर रहे हो और आप वो transaction को अपने books पे ले रहे हो, तो आपको बहुत सारा implication आता है. आपका credit risk का काम बढ़ेगा, right? आपको because वो risk आपके books पे आ रहा है, आपका capital ज्यादा रखना पड़ेगा, बहुत सारी चीजें आ जाती है. तो you will try to reduce the price और आप बोले कि मैं 97 पे ही एंटर करूंगा, मैं 100 पे नहीं एंटर करूंगा, तो मैंने एक CVA का एडजस्टमेंट किया. In lot of these big banks, they have a CVA desk. So whenever you enter into a transaction, you go and check with them what should be the CVA of this transaction, okay, and you will reduce the pricing. Okay. Supriya, answering to your point, CVA and haircut is very different, because haircut comes into agreement, comes into logic when there is a collateral being transferred. I'm not saying collateral transfer ho raha hai. There is no collateral getting transferred. I'm entering into a fresh agreement. And while entering into the agreement, because I face the risk, I've reduced the price. Shivam, this can be done for all the products. This can be done for all the products. Supriya, I've answered your query. Shaksham, I've answered your query, right? Now, I want you guys to read this section. Okay. Now, traditionally, counterparty risk management is what? Traditionally, historically, either you have a risk or you don't have a risk, historically. But now bank has evolved, and what they do is they apply limits to counterparties. What does that mean? Okay, so suppose if I'm a bank, I will put a limit that I will do transaction with Aditya Birla Group only up to $200 million, not more than that. Because if it goes above, I might face a risk. So they have limits, credit limits for all the counterparties with whom they are going to trade. So usse bada trade wo nahi lenge uske sath. The total trade ka value should not go above $200. Right? So that is the reference of credit limit. Okay. So the point which is been highlighted is that if you are entering into new transaction, okay, you have to price in that cost. So if you read this section, okay, you have to price the counterparty risk component. That is your CVA part. And we will see the bifurcation of CVA also. Okay, read this section, read this paragraph. Saksham, answering to your point, haircut only comes into collateral. That is correct. So when we hear about the concept of haircut, you basically say that I'm supposed to receive a certain asset, but I will now, instead of valuing it at 100, I will only value it, say, 95 or 97. But that is applicable when there is an ongoing trade running in, like a repo transaction, right, and all of it. But when you're entering into new transaction, the pricing that you might fix up, that pricing is very different than haircut. It's very different than the collateral discussion. CVA, answering to your point again, Shaksham, CVA can be in a case where there is no collateral. That's correct. Is everybody okay with this slide? So who all charges, what all charges comes under CVA? You'll have to wait for 1 or 2 slides. I will be addressing that. Okay. Now, if we go towards the next slide, now they have given you the bifurcation of portfolio trade level, counterparty level, and portfolio level. Now, what is the trade level? It's a single transaction that I have with my counterparty. Okay. That's a single trade. When I talk about counterparty level, all the trade with my counterparty. One counterparty. Suppose all the trade with Barclays, all the trade with UBS. Okay. Understand that first. Okay. What is portfolio? Portfolio means all my interest rate swap transaction. It can be with UBS, it can be with Credit Suisse, it can be with Barclays, Citibank, anyone. All my entire portfolio of my IRS, interest rate swap. I'm just taking an example. Okay. So what they are trying to highlight is that the trade level, first you have to be very clear what is trade level, what is counterparty level, and what is portfolio level. Let us go towards the trade level. Okay, so whenever when we talk about trade level or counterparty level, okay, what you ideally doing is you're trying to manage the risk of that counterparty when you're entering into single trade also, or when you consider all the trades. If you are entering with a particular counterparty, you will consider that CVA. Okay, you will consider that CVA, and you will take a decision how much impact in the pricing should come. Okay, suppose I'll just give you a very basic example. If I had a first transaction with Citibank, okay, I thought that there is a risk of $2 which I faced. So instead of buying at 100, I bought it at 98. That was my first transaction. So I considered my CVA. Now, after a few days, Citibank is again coming to me for a transaction. Okay, but the risk has now increased. So at that individual trade level, instead of taking a CVA of $2, I might take the CVA of $4 or $5. I might not buy at 100 for the new transaction. I might buy at 95. So at each individual trade level and each counterparty level, you will consider CVA to identify what is the incremental risk that you're facing, and you will add it into the pricing. We'll add it into the pricing. Hence, do you see over here, CVA is only specific to trade and counterparty level. Okay, read this section, the first 2 bullet points, and then I'll take you towards the book. Anusha, answering to your point, CVA is a simple charge that you're including for the counterparty risk. That's correct. But CVA is a broader term. It's also called as XCVA, which we're going to be doing in the next slide. I have answered your query. Amisha, I have answered your query also. Has everybody read this section? For each counterparty, you might have a different netting relationship. Each counterparty, you might have a different collateral agreement, because you basically do a ISDA master agreement with each counterparty. Okay, so if I'm entering into IRS related trade with Citibank, so I will have a master agreement with Citibank, which says all the basic rules and regulation. That is basically the netting and the collateral part for each counterparty. Now, when we talk about portfolio, where all the counterparties are there, because I said I interest rate swap for all the counterparty, that is my portfolio of IRS. Okay, now you have to consider the impact of correlation. Why correlation is important? Because see, when we look at the entire portfolio, you're dealing with hundreds or 200s of counterparties. If there is one default, how does it impact other counterparties of yours? And how does it increase your risk? You have to consider that. Now, it is not at a single counterparty level, it is at the portfolio level. So whenever you create some tool, you have to reduce your risk at the portfolio level, you will consider correlation risk also. And most of the time, what you do is that you basically set limit also at the portfolio level, which basically means my total exposure of the interest rate swap portfolio should not be above $1 billion. Total exposure. If it is going above, I'll have to do something to reduce it. My traders will do something to reduce it. Because what happens when I deal with so many people, okay, counterparties might default only for a particular 1 or 2 counterparties might default. But if the correlation is very high, then default of one counterparty is going to have an impact on all the other. Kindly read this part and give me a quick confirmation on chat also. Let me take you towards the book now, and similar thing is considered over here. Kindly read this part. Same part, same points. Let us go to the next part or next section. Okay, now read this section. This is slightly different. What they are trying to highlight. Okay, so when you enter into a trade, you can bifurcate the entire trade into 2 parts. If this is my entire trade, you can bifurcate into 2 parts. One part is where there is no counterparty risk, and other part where you actually face the counterparty risk. So you can read this section, the portion that accounts for that counterparty risk. Okay, that part where basically what they're saying is when you enter into a trade, you took consideration of counterparty risk into it. That is CVA. That portion of the trade which takes into account the counterparty risk that you face is CVA. And obviously the trader's objective, we can underline this line also. See, if you're able to generate a good amount of risk, okay, if you're facing a good amount of risk, your objective has to be to generate higher amount of return which is greater than the CVA itself. Then only you will be in profitable situations. Read that paragraph. Right? And like I showed you in the diagram, the CVA only covers the trade level and the counterparty level, right? Not at the portfolio level. So that is being highlighted over here, that CVA only focus on the trade and the counterparty. If you want to manage risk at the portfolio level, then you will have to take other methods, like you will have to do credit limit. You might have to use overall portfolio level calculation of VAR to understand the risk and take hedging positions also. So that is at the portfolio level. But whenever you look at individual trade risk or individual counterparty risk, you can cover it by having the CVA included in your pricing. Okay, so read this entire section, read this entire part. All good? OTC derivative cost. I am moving towards OTC derivative cost part. All good, right? Now, 1 second, I'll just show you a diagram which basically helps you to understand. Okay, this is from your GAR book. It basically clarifies, okay, nothing explicitly over here. So this part represents positive MTM. Okay, this part represents negative MTM. Okay, now read this section. Whenever you are in positive MTM, then only you face a counterparty risk, then only you face a credit risk. Okay, if that positive MTM is collateralized, that means you have collateral available from the counterparty. Okay, then the risk is slightly lower, ideally. Okay, if some or all of the MTM is collateralized, then the counterparty can choose what type of collateral to post. What does that mean? See, generally what happens is you have a set of agreed collaterals with the counterparty. So if you are asking for a collateral, he might give a collateral from that list itself. And that freedom is available with the counterparty who is at loss. He can give collateral whichever is available with him, but it should match the quality and the list which has been agreed at the start of the contract. Read that first paragraph, positive MTM. Right? Now, if you are into negative MTM means you are at loss. Now you have a decision, okay, to basically provide a collateral. Okay, now if suppose if you read this paragraph, that when the transaction is out of the money for you, that means you're actually not making any money, you're actually at loss, then there is a counterparty risk from the party's own default. Okay, and what primarily happens is you're not facing the risk, but the counterparty is facing the risk because you are at loss and he's at profit. Okay, and now you have to face the funding impact cost, and he will get the funding benefit. What is the funding benefit? See, when you give collateral, okay, your money is stuck in that collateral because you're paying in the market and getting that collateral, right? So if I'm in loss, I have to give collateral, so it's a funding cost for me, and for my counterparty it's a funding benefit because he's not giving the collateral, he's receiving the collateral. He can use that collateral for some other purpose also. Read that paragraph. All good? Any queries? Girish, you can ask your query.
Yes. So if a collateral is posted, for example, okay, so if I am posting some collateral, say some bonds or any other security, so whatever benefits are coming from that security, like some dividend payment or some coupon payment, that will be
Your
owned
own.
by the counterparty or by
No, your own. The legal right is with you. You're only giving it as a collateral. So what happens is
Okay.
the income that comes in that in the asset, it has to be given to you,
Okay.
right? Funding benefit means, think about this, Saksham. If you are entering into a transaction, I'm explaining this in Hindi. अगर आप कोई ट्रांजैक्शन में एंटर कर रहे हो और आप प्रॉफिट में हो, आपको एसेट मिलने वाला है, तो एसेट तो आपके पास पड़ा हुआ है ना, आप उसको यूज कर सकते हो, आप कोई दूसरे ट्रांजैक्शन में उसको एसेट दे सकते हो, तो आपके लिए तो बेनिफिट है ना वो, राइट? दैट इज फंडिंग बेनिफिट. somebody who's posting the collateral, उसको कॉस्ट लग रहा है, राइट? Amisha, you can ask your query. Resolved? Okay. Let us come to the book, and I want you guys to read this entire part, entire section properly. They're explaining the same thing. Sagar, answering to your query, if the contract is in the money, that means it is favorable for me. If it is out of the money, I am at loss. I have to pay. Right, Sagar? If this is done, we can go towards the next concept. Yes, Amisha, you can ask your query.
Sir, so when it is positive MTM, how do we have funding benefit?
Because somebody else is going to give you the collateral. Huh?
So uncollateralized component, funding cost arise. What is
Wherever
what
it is.
third? Yes, sir. This
Counterparty risk. Okay. The transaction is in the money. So if it is uncollateralized, what does that mean? That out of total $100 which you were supposed to receive, ideally, only 70 is a collateral is posted for only 70 as per the agreement, because in agreement you also have threshold. There are those concepts also which we're going to be doing in the further chapter. But what I wanted to highlight, suppose I was supposed to receive $100, my exposure is $100, but my collateral, the collateral which I've received is only 70. So what is my uncollateralized part? 30. So you still face that risk, no? You have to cover this risk. You can enter into a hedging instrument. When you enter into a hedging instrument, that's a cost for you.
got it.
If everybody is okay, we are moving towards the last part, which is XCVA, market as star. Now, if you want to understand this concept, I have highlighted the section over here, which this is from the book. What they're trying to highlight. Now, think about this. Suppose the basic valuation of the asset was 100. Okay. And counterparty comes to you and says that, okay, I want to enter into a transaction at 100. Now you check, okay, the CVA. Now CVA is just a generic term. There are also other XCVA. When we say XCVA, it can be FCVA also, FVA also, it can be KVA also. Now they have given the bifurcation over here, okay. But that XCVA means apart from CVA, you also face other impact related to it, okay. So what are those problems? So suppose if counterparty comes to you and asks, say that I want to enter into 100, but you say no, I face CVA, so the price is going to go to 97. Okay, you do further calculation and you feel that, okay, if you enter into this transaction, okay, you might face some funding cost also, because you might have to give collateral, because if you're in loss in the contract, when you, after some time, suppose if you're in loss, you'll have to invest your money to get a collateral and give it to that part. So you'll have to take that into consideration also, and you'll say, no, I will not buy it at 97, I will buy it at 96 because I face funding value adjustment. Okay, whenever there's a cost involved which associated with the funding part, I've explained that section now. Okay, apart from that, funding also can be treated as that I have to take other position to manage the risk. Okay, some uncollateralized part is still there which I have to manage, so I'll have to enter into some other position, so that is connected to your funding part. You also have to keep on posting collateral in the transaction. So if you feel that in this transaction you might have to set up a team, you might have to continuously manage the collateral movement, so that is a cost for you. So you will say, no, I will not enter at 96, I will enter at 95 because I face a collateral value adjustment. Collateral value adjustment. Okay, further, because you are entering into that trade is coming in your book and you're facing a risk, and as per Basel requirement, you have to keep certain amount of capital within yourself because of that trade. So additional capital is getting assigned, so that when you keep additional money as a capital, it is a cost for you. So you are saying, no, we cannot enter at 95, we will enter at 94 because I face KVA, which is nothing but regulatory capital value adjustment, because you have to hold the regulatory capital. Okay, 94. Further, if you face that, there you might have to post initial margin. Now in OTC derivative also, in a lot of transaction, you might have to keep a margin, initial margin, separately into an escrow account, okay, which is used to make payments to each other. If they want to, if there is something in the contract which you have to pay to the counterparty, so that initial margin will be used. The same way you use it in futures contract, but over here you have to put it in the escrow account, okay, where the account will get debited. There might be an agent bank sitting in between, there might be some custodian sitting in between who will help you to do that. But the point over here is, since I'm entering into a transaction, I have to keep, say, $10 million aside in the initial margin. This is apart from the capital. This is because of the transaction, I have to keep that money. So it's a cost for me. So I will not enter at 94. I will enter only at 93. And this is, as per me, the correct valuation. Now, on this entire thing, is there any query? So, okay, what is really happening is, so counterparty might come and say, I'll redo the entire thing. So counterparty might come and say that let us enter into a transaction at 100. I will do all of this calculation and I will say, I will enter at 93, not 100, because I face so many costs. Obviously, this entire calculation is done by the bank and backend. Now, on this explanation, do you have any query? Sagar, I will take your query in some time. Wait. Is there a query on the explanation from 100 to 93 on that part? Yes, KVA will be applicable to counterparties also. So this is from your perspective. The same way, the counterparty might also do its own analysis, huh? And then they will come to a fair price. That's correct. Okay, I'm explaining this in Hindi. से एकदम सिंपल बात है कि आपको किसी ने आके बोला 100 रुपए में ट्रांजैक्शन करो, आपने बोला नहीं, बिकॉज मुझे काउंटर पार्टी रिस्क फेस हो रहा है आपके साथ, तो मैं 100 पे नहीं करूंगा, 97 पे करूंगा. That's the first adjustment that you have done. Okay, सेकंड, आपने रियलाइज किया कि आपका जो भी अनसिक्योर्ड पार्ट है इन द ट्रांजैक्शन, उसके लिए आपको जाके कुछ एक्स्ट्रा कॉस्ट भरना पड़ेगा, कुछ हेजिंग करनी पड़ेगी। तो आपने बोला 97 भी नहीं, 96 पे ट्रांजैक्शन करेंगे। कोलैटरल वैल्यू एडजस्टमेंट का मतलब क्या है कि आपने रियलाइज किया कि बिकॉज इस ट्रांजैक्शन में जब मैं एंटर करूंगा मुझे कोलैटरल्स रखने पड़ेंगे ओवर अ पीरियड ऑफ टाइम, कोलैटरल रखने का भी कॉस्ट आता है, राइट। तो उसके लिए आप 96 पे नहीं 95 पे अपने प्राइस लाया। आपने ये भी रियलाइज किया कि इसके अंदर रेगुलेटरी कैपिटल है, ओके, इन्वॉल्व। तो रेगुलेटरी कैपिटल के अंदर आपको रेगुलेटरी कैपिटल रखना पड़ रहा है बिकॉज आप ये ट्रेड में एंटर कर रहे हो, तो आपका प्राइसिंग हो जाएगा 95 का 94। एंड अगेन फाइनली, अगर आपको लगता है कि इस ट्रांजैक्शन, अगर उस ट्रांजैक्शन में कोलैटरल इनिशियल मार्जिन रखना पड़ रहा है, तो वो भी एक कॉस्ट है आपके लिए। तो आपका प्राइस 94 से 93 हो गया। आप बोल रहे हो कि 100 नहीं, मैं तो 93 पे एंटर करूंगा। सिमिलरली काउंटर पार्टी ने भी कुछ एडजस्ट, कुछ एनालिसिस करके ही आपके पास आया होगा, तो वो नेगोशिएट करके देन दे विल कम टू अ प्राइस। इज एवरीबडी ओके? MVA, Shivam, I have answered that query also. Now all of this is also given over here. ये देखो, you can read this part and also read this section. I've tried to give you as simple explanation as possible. Kindly read this entire section. Now, debt value adjustment is basically, for me, if it is a CVA, the counterparty के लिए DVA हो जाएगा. We call it as debt value adjustment. So it's basically two part of the content, and this concept of DVA is again going to come in your further chapter of CVA itself. वहां पे एक chapter है, content है. Kindly read this entire part. Yes, CVA is equal to DVA, but from the other perspective. You can read this line. DVA defines counterparty risk from the party's point of view, not my point of view, my counterparty's point of view. They are also doing the same thing. Should we go towards the section? सक्षम एक ही बात है, आपके लिए सीवीए है, आपने कैलकुलेट किया वो सीवीए वाला पार्ट था, एक्स सीवीए वाला पार्ट था। सिमिलरली काउंटरपार्टी के लिए डीवीए है, वो उल्टा, राइट? लेट अस गो टू दिस क्वेश्चन. कैन यू गाइस स्टार्ट रीडिंग दिस क्वेश्चन? I'm starting the reading now. Odeon Financial Inc. used a variety of techniques to manage its counterparty risk. It has entered into an interest rate swap. Currently, in the swap, the Odeon's position is -1 to negative mark to market. Hai. Based on the information provided, which of the following credit risk technique would be the most advantageous? See, you are in loss, and if you look at all of this, see, closeout does not help you. You still have to pay. But if you look at walk away feature, if you're a negative out MTM, Saksham A cannot be the answer because this is not the most advantageous. What is most advantageous? Walk away. That means if there is a feature of walk away in your contract, that means if counterparty defaults now, you have to pay $1 million, right? As per the contract, you will not pay if there is a walk away feature. So it's more, it is better, na, for you. I hope it is clear. Let us go to the second question. Which of the following methods of mitigating counterparty risk is most likely to generate systemic risk? Now, see over here, the point of reference is this. So what happens is when there is a CCP involved, lot of people, everybody deals with CCP. So it helps to reduce the network risk in the market, in the OTC market. Okay. Now, what is the network risk? People are dealing with one another. Okay. But what happens is, if suppose the CCP itself default, then there is a systematic risk. And hence what regulators also do, okay, they basically, they try to give more control on CCP. That means they will ask him to keep more capital, more money, more stringent rules for CCP, where they can invest their money, at till what time they can invest. So all of this is basically covered. Okay, so the answer to this question is, which of the following can increase or can lead to systematic risk? See, A cannot be the answer because netting will never increase your risk, right? Collateral will generate your liquidity risk, legal risk, but not systematic risk. And when you do hedging, it does not increase your risk, it reduces your risk, right? So your answer has to be D. Is everybody okay with this entire chapter? Give me a quick confirmation on chat. It's a systematic risk, yes.